All right. Thank you, everybody, for being here. Nice to see you all again. Good to see you guys. Let's just kick this off. Maybe, I think what we'll do is maybe do two chunks to the conversation. One, maybe just like set a bunch of context for everybody, get everybody on the same page about terminology and kind of how things work. And then the second section we'll call hot takes, where I'm going to ask you guys questions and hopefully you all disagree with each other because that's a lot more interesting for everybody here. Okay, maybe just start it off to define some terms. How do you all think about what is tokenization exactly? Like, how would you define tokenization, and how do you think about kind of the key pieces of infrastructure to make tokenization work? Who wants to start?
I can start since I'm the only tokenization platform here. Well, these guys are asset manager more. Tokenization is the process of representing the ownership of an asset on a blockchain through a token, right? So the tokenization itself implies that the representation of the asset, of the ownership of the asset, is done on a public distributed ledger as a blockchain. And what it involves, it depends on what is the asset that you're tokenizing, right? Because in some cases you could tokenize a commodity, you can tokenize dollars, you can tokenize securities, and depending on what is the underlying asset, the amount of infrastructure is vastly different, as well as the regulatory framework of how you do it, which is very, very important. But it involves some sort of technology process for issuing the token, as well as tying back the ownership, the legal ownership of the asset back to the digital representation of the token, and then controlling how the token flows across the people, depending on the legality of the transfer, etc. But for the most part, that's what.
So let's try to make that really concrete for everybody. So maybe Justin, you want to start? Like, how does that actually work for Ondo? Like end to end, how does a dollar actually get tokenized, or how do treasuries get tokenized? Can you walk us through kind of like end to end process? How does that actually work?
Yeah, I think in tokenization, I think is sort of defined as sort of a complement to other tokens that exist, that are these digitally native tokens that are sort of born on blockchain and live on blockchain entirely, whereas tokenization sometimes refers to real-world assets where there's a token representation, and then that is actually tied to some assets in the real world, and you need to make sure that that tie has integrity and, of course, is done in the right way. So our main products are effectively things like money market funds or treasury bill-like products, where when you buy the token, you get the same financial profile as if you did the same thing in a traditional asset. And so when somebody comes to us and sends us money, they can either send us stable coins on chain, or they can send us money the old-fashioned way, via a bank wire. When money comes in, we then mint new tokens or create new tokens, and those tokens are then given back to the actual client. And with that money that we get, we go in the real world via our broker-dealer. We go buy something like an actual T-bill, or we buy something like BlackRock's securitizes BIDL, where you have to make sure that you have that mapping one-to-one of like what the money is in the real world versus what the money is represented in token form.
And can you speak a little bit to like how does the actual token get created? Like at what point are you doing KYC if you have to do any KYC, and how does that handle? Is that done in-house or third parties? How does custody work? Sergey, I'm sure you have thoughts on like how oracles actually like help people on chain represent the parts of the process. Can you just speak to like the components here that are actually required? Like abstractly speaking, tokenization seems like really easy, right? There's a smart contract, and you sent me some money, and I like gave you a token. But there's like a lot of infrastructure behind the scenes. And so can you guys speak a little bit to like what are these pieces of infrastructure that are actually required to actually make this work end to end? Like what are the key pieces of infrastructure? Like how do you think about KYC? How do you think about
if the token, if you're tokenizing a real world asset, for the most part, you're issuing a security, because either you tokenize, as Justin was saying, a fund like a money market fund or a private equity fund, whatever type of fund. So that's a security, or you can tokenize equity, debt, etc. Or you're taking an asset and you want to provide fractional ownership through the token, then you have to securitize the asset to be able to assign, from a legal perspective, the underlying financial ownership of the asset to a number of different investors. That's the securitization process in traditional markets, just brought into the blockchains. From that perspective then, because that token represents a security, it's a regulated entity, a regulated instrument, and therefore the wallets that contain that token need to be KYC, need to be associated to a real world identity of an investor that has been KYC, has passed AML, etc. So you have to do KYC first You have to then whitelist the wallet of the investor, and then you can then issue the token there if it fits the requirements of the regulatory framework. So that's a requirement for 99% of the real world asset tokenization, except for stable coins, I would say.
And do you guys handle KYC in-house, or is this like a third party that you offset it to, or how do you actually do that?
We are regulated entities, so we do it ourselves.
Got it.
Same.
Got it. Okay, so now the token exists and it's in a wallet. Is it tradable? Is it, are they allowed to do things with it, or just have to sit in that wallet? Like, how do you think about kind of what happens when it's in the on-chain world? So there's sort of this infrastructure that you have to do the KYC and create the token and get the money, and on the back end go buy the asset that is supposed to represent. When it's on-chain, what happens? You can do anything?
If you don't do anything with it, my recommendation is don't tokenize, because then you're just basically using a more cumbersome ledger than just using some other ledger technology. So there is a lot of people that tokenize a bottle of water and issue a token on the blockchain that you can't do anything with it.
Yeah.
That's a waste of time, and I think one of the reasons why tokenization hasn't taken off, because a lot of these tokens don't actually improve on anything.
Yeah.
So my view of the world is that you need to tokenize for the token to be able to actually provide additional utility to the security of doing something that is hard to do in traditional finance. And then in our case, for instance, we do peer-to-peer transfers across whitelisted wallets. That allows you to transfer the ownership of the security in a very, very efficient, instant way. That's very difficult to do in traditional finance. That leads to potentially better trading of or liquidity. That involves other things, of course. We do instant redemptions on chain. We do issuance of dividends on chain directly into the investors' wallets and things like that add value to the token, besides just using a better ledger to represent the ownership.
And when you start doing these things, let's maybe double click on the idea of like what is on chain here and what does that look? Are you guys operating mostly on L1s? Are you mostly L2s? How do you think about, maybe Sergey, you can speak to this, how do you think about permissioned versus permissionless ecosystems and chains, and does that create any like risks and liabilities? So could you speak a little bit about kind of like the on-chain infrastructure that you're using to actually create these assets and move them around?
Yeah, sure. Yeah, so I think you need kind of four things for all this work. In addition to the blockchain, you need a tokenization platform, like what Securitize creates, which is used by the majority of the great institutional clients out there today. So that's really great work. Then you need Oracle networks to create what's called a unified golden record, which is getting all the off-chain data into that token. And the more data in the token, the better the token, in my opinion, because it does more risk management, proves more things, is more secure. That's what we call a unified golden record. And that token can exist on these public chains or these private chains. And then you have all kinds of really good distribution mechanisms, which is not exactly what Ondo is, but that's kind of what I view it as something that can help package things in a way that's easy for people to consume. And then you have DeFi protocols that generate yield on it. You have all these kind of distribution channels that are optimized for people to gain easy access to these things. And then all those things need to work together. They can work on public chains or private chains. Really, the distinction between public chains and private chains, I think, is a little bit confused. Because on public chains, you can have very hard to access financial products that are effectively private as far as who is able to access them. So the membership of the product can be very limited, right? Under a set of conditions, it's on a public chain, but there's a very limited group that can access this financial product. Then you can have private chains that it's easier to join than it is to gain access to this public chain financial product. So I think the distinction between public chains and private chains is just going to kind of go away, especially with good connectivity across chains that's seamless. And that's one of the final pieces that needs to be put in place, is that you still have a lot of fragmentation about where private key value is. But once you have a good cross-chain system that efficiently and seamlessly and reliably connects all the value on all the chains into one, what we call Internet of Contracts, then launching that financial product on any one chain doesn't limit you to the user base in that chain. It's kind of like in the internet, you launch an internet application. There's not like the Spanish internet and the American internet. There's not like different internets. The people from Spain can access the American application, and it's all one big internet, if that makes sense.
Well, to extend that analogy, there is a Chinese internet, which is...
Yeah, I'm going to disagree a little bit here. So
yeah, please.
I think these permission private blockchains, in my opinion, are a bit like glorified databases. because first they're closed, so only approved participants can participate. They're not necessarily decentralized. They tend to be like in a single data center, so they're not resilient towards specific attacks, etc. So I think this is similar to what, going back to the internet analogy that Sergey was doing, when MSN or American Online launched, and they had this mini internet that was only the approved content that they were putting there and only the people that were connected there. And that obviously didn't work because all the innovation happened on public open networks like the internet, right? So public blockchains are what it is, and a good example is what Ondo is doing, for instance, with Biddle, where they've done an integration for redemption and issuance on chain, directly integrating with the smart contracts that were on a public blockchain without talking to us, basically. so that would not have happened if it was a private blockchain where we have to give them permission to access it, and then you're in a data center, you have to use a VPN to connect. Like we've done integrations with private blockchains. It's a very painful process that doesn't lead to open innovation at all.
So just to probe on that a little bit, though, I mean, America Online was actually how most people accessed internet services for many years. It was sort of the on-ramp before you hit the public internet. It was almost sort of, like at peak, there were tens of millions of users paying them every month.
Yeah, I think it's all, what I'm saying is the America Online, the MSN, and all this stuff, it's just because there's different protocols.
Yeah.
And there isn't like a simple way, efficient way to make them all into one internet. But eventually they all merge into one internet. Like AOL merged into the internet, and whatever MSN was merged into the internet. It's all just one internet. So I think we're just going to arrive at a similar place.
Yeah.
Where I might have started on AOL, and you might have started on MSN, and you might have started over there. But eventually they just merge into one internet. And actually on the back end, MSN and AOL and whatever, they can all use different database technologies, and they could all use different clouds or whatever, but they're going to merge into one internet. And that internet isn't defined by the database technology they use. It's defined by the protocol that connects all of them into that internet, namely TCP/IP, right? That's what creates the internet. So this is kind of where it's going to evolve. And then there's just going to be different levels of access control to, like, I'm on the internet through MSN. Man, this password system is real shit. It forces me to make a special character in the password. It's really kind of annoying. I get into the internet through AOL, and it has a better password. That's like going to be the distinction, right? But you're going to be on the internet, which is going to be a collection of different technologies that are synced together over a single standard, over a single protocol that defines how they interact with each other, right? That's what the internet is.
I'm kind of curious from the market perspective, do you guys see different sorts of entities that are actually interested in this today? So obviously BlackRock is playing with this, but who else are you seeing that's actually interested, both on the supply side and the demand side? Like who wants to tokenize assets and is interested in tokenizing stuff, and where are you seeing the demand side? Like where are you seeing people come in and say, I actually want access to these assets in a tokenized form? Like what are you guys seeing in market these days?
So first, I think saying BlackRock is playing with this is a bit of a disservice to what they're doing. It's a real project with a commercial objective that has grown to be the largest tokenized asset in the world. I don't think that it's a pilot or an experiment. It's something that they really see commercial value. And I think that what we see is that there's two things. Like if you think about 5 years ago, people saw tokenization as a maybe more efficient way to reach TradFi investors, and at that time, crypto was really not big enough to be a target audience. But if you think about now, crypto went from like 5 years ago being $200 billion to be a $2 trillion. So now that suddenly you have, a crypto audience that is large enough that want to access TradFi assets on their crypto ecosystem for benefiting what they're doing in crypto. And I think that has been the shift of the thinking of the asset managers in terms of why do they want tokenization for? Not just to be more efficient on the TradFi space, but to basically bring TradFi products on chain for the crypto economy, which is now large enough to be meaningful to them.
Is this what you guys see too?
Yeah, I agree with all that, certainly. I think in terms of supply and demand for tokenization, there's tons of supply of people who have non-tokenized assets that want to have a tokenized version of them, either for marketing purposes or they think that it's a up-and-coming, growing place to sell, to distribute their assets, which is like somewhat true, but also crypto is still very small. So I think there's an imbalance between asset managers that want to tokenize their assets versus the actual organic demand on chain for those assets so far. I think all of us on stage probably believe that all the world's assets are going to be tokenized at some point in the future. We're definitely not there yet, and we're still figuring out how long that's going to take and what the right path is going to be and what the next assets are to be tokenized. But I think there's still a little bit of a supply-demand mismatch between issuers who want to tokenize their assets and then actual on-chain demand for some of these traditional assets, just because the traditional assets are maybe a little bit boring for people who have their capital on-chain, and there's sort of lots of much more risk-on things that people can do with their capital on-chain.
So another way to say that is you think degens don't want low-risk assets. Like there's a mismatch between like those assets. Well, let me throw a question to you guys, because I think it's a good segue maybe into the hot take section. Now that everybody sort of has context on the market and sort of how this works. What are the assets do you think that get tokenized early? Like, that from a success perspective, if you were to tokenize them, you might actually have a shot at actually making that a successful market. And kind of relatedly, what are the assets that you think are getting tokenized that actually nothing's going to happen? Like it's just too early. And so how are you guys looking at which asset classes actually matter here?
I haven't been in the space since the first fail wave, if you want, of 2017, 2018, where everybody was very excited about tokenization. And now that people are excited about tokenization again, I think that back then and throughout the years, people thought, as Justin said, everything is going to be tokenized, and people started like, I'm going to tokenize, I remember a project from another company that no longer exists, that they were like tokenizing a student dormitory in North Carolina. And if you think about it, that makes no sense, because it's very difficult to really add any value through tokenization to a student dormitory in North Carolina, because it's a small single asset. It's difficult to understand what the benefit of it is. You're not going to get it liquid anyway because it's an illiquid asset by definition. There's not necessarily demand for those assets, etc. I think today the approach in the industry is a bit more pragmatic, and they're looking at the number one tokenized asset today is the dollar, right? $160 billion of stable coins. So what's coming next? Then anything yield-bearing dollars. So that's what Justin is doing with their products, what we're doing with BlackRock, with Beetle, etc. And if you think about it, in traditional finance, there's $2 of treasuries for every dollar of actual dollars. And in crypto, is the opposite, because it hasn't been an efficient tokenized treasury product on chain that crypto people can really use. So they have to use the stable coins for things that in traditional finance nobody will use stable coins, just because there's no on-chain treasuries. I think that's the asset class today that is growing faster than stable coins. It's $2 billion, which is really, really tiny for what it should be. And I think the next evolution, especially now that interest rates are coming down, is anything adjacent. Floating rate products, credit maybe, CLOs and things like that are kind of like the next adjacent thing. But all these long tail assets like single asset real estate, etc., I think will take very, very long time for tokenization to really be a thing there.
So obviously not financial advice, but so you guys, I'm curious, so bullish or bearish real estate tokenization on chain?
I'm bearish.
over what time frame, right?
Let's say next 5 years.
Not going to happen.
Not going to happen?
You're
pro on it.
Like maybe you can tokenize maybe a REIT.
Yeah.
Or you can tokenize, a yield-bearing, like I don't know, some sort of like a big debt product, but not individual homes. Put them on chain to make them more efficient or liquid and stuff like that.
You think tokenized REITs might happen in the next 5 years? And people
I think tokenized REIT possibly. Like if you look at, for instance, Blackstone, they already have a successful publicly traded REIT, right? So there's no reason why this shouldn't percolate into the crypto economy within the next 5 years. But that's not real estate as people perceive tokenization of real estate 5 years ago when the industry started. That's like a fund, basically, that happens to contain real estate assets.
Sergey, what do you think? What's your thought on this?
Yeah, so basically, I think the things that have a lot of potential are the things that create diversification for like the Web3 community. That's one of the reasons things like Terra happens, is because their collateral and what backed it wasn't diversified. I think that's what this more traditional financial product of treasuries is very useful for in the Web3 community, is it creates diversification of the underlying assets that isn't like crypto backing more crypto backing more crypto. So that's a really useful thing, especially if it can generate yield. I think anything that's hard to own that generates or has a big group of people believing it could generate yield, this is like tokenization of private equity. That's an example. It's hard to enter those funds. It's complicated. You have to have a minimum, these types of things. And people have beliefs that certain categories of certain venture or equity fund, private equity funds can generate yield, but it's hard for them to access them. And then the third category, which is where real estate comes in, is where fractional ownership would be valuable, right? And there I think is different market dynamics in different regions. So there's different regions in the world where, like in the Middle East, where real estate's a really big deal, and people really want to invest in real estate, and they want to do it in a fractional way, and it's like culturally really accepted and a good idea, and it's viewed as a form of diversification in addition to gold, in addition to other things. And then there are places where there's like a lot of financial products, and there was the real estate crisis in 2008, and people are like, real estate's a bad investment. But I think anything where you can take, let's say, $100 million building of some kind, like in the middle of Riyadh or something, and you can tell people, hey, you can own a piece of the Kingdom Tower, and you can own that. And that's like, wow, what an amazing thing. I can own that? That's cool. I couldn't own that before. And anything where like fractional ownership of something that has real value in people's minds, I think that still has a lot of value. Because you're basically now able to aggregate demand from a bunch of people that previously were not demand, right? Because they couldn't meet the minimums, the friction was too high. That, fundamentally makes sense to me. I think there need to be good user applications, like end user applications that do that. So end user applications make it very easy for me to have a fractional share in, piece of art, building, stuff I believe in but wouldn't be able to own. I think there's a pretty cool market there, in my opinion.
Do you guys agree, disagree? These use cases make sense?
I sort of have a lot of thoughts in my head about all this. I think if real estate tokenization is going to happen, it's going to be something like here in Singapore or in like Dubai, where it's a very real estate focused economy, and they're a little bit more sort of simpler regulatory structure where there's one or only a few regulators involved in something.
So not in the U.S.
So I'm American, so I apologize, but my sort of American-centric view of this is like a lot of the real estate data isn't even digitized, let alone tokenizable. So county by county records of who owns what, and all of the real estate is really non-fungible tokens, right? If you own a condo on the 20th floor versus the 60th floor, those are not the same price. And then I think I can talk a little bit more about why we started where we did. And this really harkens back to, I think, Carlos and my mantra is that you actually have to just use the tokens. Otherwise, just go buy the private equity or private credit thing. And if you're never going to use your private equity shares to do anything, like you might as well not tokenize it, right? So we were the first ones to get any material amount of adoption in a tokenization project. And by material, I mean north of $100 million of TVL. We started with effectively a short-term cash management asset that people could actually use to do short-term cash management on-chain. So if you have dollars on-chain and you were looking to get out of those dollars and invest in something like a money market fund or T-bills, you literally had no real option to do that before. But we saw a need for people doing that, both for cash management of just, I'd rather earn yield on my dollars rather than not on-chain, as well as what I think is a much more interesting but longer-term use case, which is actually using these things within the DeFi protocol machinery themselves, and in particular as collateral for these various different protocols. The two main types of finance protocols on-chain are lending and trading. T-bills are widely used in the traditional financial world as collateral for both of those things. And so it makes a ton of sense if you're putting dollars in stablecoin form into, say, an AMM, and you're putting in asset A and dollars and putting in 50-50 of each, you'd actually much rather have yield-bearing dollars in there. So while your money is LPing, you're actually earning a yield on the dollars, right, rather than paying the yield to the actual stablecoin holder. And so we're starting to see uptick in that. We're north of $10 million of liquidity actively in various different DeFi protocols. Another thing that clients really care about is really quick redemptions. And so we have a really cool project where we've worked with Carlos's team at Securitize to offer 24/7 redemptions effectively atomically within the redemption transaction. So when you redeem, you send the tokens back to us, and in that same transaction on chain, we actually work with their smart contracts under the hood to source liquidity and return you stablecoins in that same atomic settlement, effectively, like atomic redemption. Another thing people always talk about is like atomic DVP. We won't talk about that yet, but getting to the point where people are actually getting a demonstrably better result financially, like from this actual use case. Like you actually have to have, and we were talking about this a little bit backstage earlier, an actual use case to drive adoption, right? Like I think there's a lot of sort of Field of Dreams-esque, if you build it, they will come type tokenization projects, and I think those are cool, interesting projects, but if you're running a startup, you might run out of runway before the market gets there. So I think you have to be relatively ruthlessly practical about what to tokenize now. And so we started with these very cash management-like products because people actually are using them for cash management.
Yeah,
I disagree with that. So like the use case that Sergey said about fractional ownership for real estate or art, if you think about, there is a lot of startups that have tried that with centralized systems. There is Cadre, which recently got sold in the US for nothing, and they raised a ton of money over time, and they completely failed. Masterworks, it's question mark whether they're going to survive. And then they do fractional ownership, right? They just don't use a blockchain, they just use a centralized database. But for the consumer of the product, and by the way, those are actually pretty good user experiences. So they, for a consumer of a product, whether the underlying shares are represented on a distributed ledger or not, is completely irrelevant. And I will argue that if you actually use a token, then you add friction because then people need a wallet, and not everybody, unless you're in crypto, are familiar with the concept. So if the whole purpose of tokenization is providing fractional ownership, I think it will not succeed. You have to do something else with the token. It's like you can put it on a DeFi protocol to make it more valuable, or you can then, if you really reduce the cost, then it has to translate into a huge amount of value for the end investor of way lower fees, which is really not the case yet, because tokenization also adds other type of frictions today, etc. So I think that, yes, all these things conceptually sound like the right thing to do, that tokenization can solve all these problems, but the reality is today, they don't yet. So.
But are you not sympathetic to this idea? Go, Sergey. Go.
Yeah, just one quick thing. So I totally agree with both of you. I think what's happened, for example, for this money market example, is that the securitized team has done an amazing job kind of navigating the legal complexity of generating these tokens, right? And making them available to the ecosystem. And then I think what Ando did is made a really good, what I would call user experience for both users and for the protocols that then consume these things. And that is, so I agree with both of you that there needs to be more value to that. But I guess what I'm saying is that somebody like Ando, somebody like you will do a really good job at generating the tokens. And then somebody like Ando will come along and generate a really good user experience for those tokens to make the demand for them efficient or seamless or valuable. Like they'll figure out a way how to make the adoption of a tokenized piece of real estate valuable to the user through some set of economic mechanisms, some way to like, maybe you can earn yield on your real estate token, and that's like a mind-blowing thing because you couldn't earn even 0.1% of yield. Like I don't know what those things are, right? Mm-hmm. But like the permissionless innovation thing that you folks have experienced, right? And has helped make what you do successful, like this kind of combination is, I don't know how it's going to happen in every vertical because I don't know enough about each of those verticals. But I think this pattern will repeat itself.
I think that's definitely, there's sort of that argument. I think there's another argument, I'm curious how you guys think about this, which is if you think about, let's say something like Polymarket, which is doing phenomenally, right? A lot of people have tried to do prediction markets in Web 2 for a long time, and they never quite worked. And so there's an argument, and just to be clear, we're not investors in Polymarket or anything, right? But like,
but you are.
So I'm not shilling our portfolio. But I think there's an argument that this is a kind of like what you're saying. There's a new capital market here, and there's a bunch of people that have dollars now on chain, and it's a different group of users than have historically had dollars, and that capital market may seek access to instruments or tools or products that the traditional Web 2 people didn't really care for. And so prediction markets might be an example of this, which is like the Web 2 prediction markets never worked. The Web 3 prediction market looks like it's kind of working. So are you not sympathetic to this argument that like?
I think that the reason Polymarket is successful is because the Web 3 audience likes gambling and DGN stuff.
Sure.
And then that's why they like Polymarket, and that's why Polymarket has been successful.
But is gambling on fractionalized art, like if I
well,
gamble
so
on a
fractional
basketball
art
ad or something?
or fractional real estate is a lot more boring, right? There is a lot less gambling expected. Like the amount of the returns you're going to get are going to take way longer. They're going to be much more predictable, much more stable. And I think that the crypto audience, they have an appetite for these boring products, right? I think treasuries are largely not being used by the crypto users, but are used by the crypto institutions, as Justin said, for posting collateral instead of posting stable coins or doing other things. So I don't know if the crypto DGen individual investor that can gamble out in any of the million tokens that are out there or in Polymarket, betting and getting a reward within a week about whether
So it sounds like you're actually positing something about the market here, which is kind of interesting, which you see in a lot of markets, which is sort of this barbelling, which is you're saying, it sounds like, correct me if I'm wrong, that on-chain tokenized dollars and treasuries, sort of the lowest risk asset that can be used as collateral, is a very interesting thing, and there will be many, many billions or maybe many trillions of dollars of that, because that's a fundamentally utilitarian, useful thing. And there's a bunch of stuff in the middle, art, real estate, whatever, which is not so safe and not so risk-free and doesn't generally get used as collateral and is not so risky that it's interesting in terms of generating 40% a year. But that might imply then what you're saying is that there is a set of assets that could generate 40, 50, 60% a year that are extremely risky that might be very appealing to this audience, like a Polymarket. And so is that, abstractly speaking, like suppose I'm a founder today and I'm thinking about what you might want to tokenize and I can't compete against a Hundo or Securitize. It's regulated, it's KYC, it's TradFi, yada, yada. Does that imply that there's a group of assets out there that if you could go and say you can make 40% a year on this or 50% a year on this, that actually the crypto capital markets on chain might be interested in that?
That's a good point. So we've thought about, like, if you think about one of the reasons, for instance, on the DGen side of things, but not Web3, a company like Robinhood has been very successful with short-dated options, which are basically gambling
DT options,
on something. So if you could bring those kind of products on chain, those could be attracted for the crypto people. Of course, you're competing with the frictionless, let's say, gambling that you can do on DeFi on Polymarket, where there's no KYC, there's no friction at all, right? So all these other products, by nature, they're always going to have some degree of friction because of regulations and stuff like that. So, but yeah, I agree with you. There are all the products maybe that are...
Until Ondo makes it easy to use.
They still do KYC.
I'm very happy to hear that we have a good user experience. That's great. I mean, we've certainly put a ton of time and energy and love into the product experience. I mean, I think that all this. I mean, it's so cliche, but all this stuff's just going to take so much time. Like we're at an all-time high. We're north of 600 million now in our TVL, or what traditional people call AUM. And it's growing probably very quickly in comparison to any kind of traditional financial thing. I haven't looked at the numbers, but it's definitely like double-digit % month-over-month type growth that we've seen since launching our most recent product. But I think we have to remember that not everybody is at this conference, not everybody is in these conversations, and they're still learning a lot of basic things like, what is an oracle and how do they get this information and why should we trust them? And what we sort of take it for granted. Like we obviously know who Chainlink is and Securitize is and those types of things, but like this is just going to take so much time. Like the traditional financial system is going to be tokenized. I think we all agree with that, but I think the time frame for this is very, very,
It's longer than people think.
Yeah, I mean, it's the famous Bill Gates quote, right? It's in the short run and versus the long run. Like in the long run, they'll get here sooner than we think, but
I think it's an infamous Bill Gates quote. It's people dramatically overestimate what's possible in 2 years and dramatically underestimate what's possible in 10 years.
Yeah, which is probably good in this space. Keep in mind that this is a regulated environment, right? As opposed to other things in crypto that can flourish and grow very quickly. Yeah. So we're constrained by definition of the nature of the products that we're bringing on chain.
Yeah. So we're almost up on time here. So maybe last question for each of you to close it out. Suppose we're all back here in a year, 2049 and in 2025. What is going to surprise people the most about what's happened over the last 12 months? And meaning over the next year, what do you think is going to surprise people the most in this area? Sergey, you want to start? We'll just go down.
I think the amount of value that will flow in to the TradFi ecosystem from the Web3 community. And I think by this time next year, it's September, October, Yeah, I think there will be more institutional adoption of crypto as well. So I think there will be more Web3 crypto adoption of TradFi products, like what Securitize makes and kind of what Anu makes and those things backed by more traditional systems and processes. And I also think the institutional industry, the traditional kind of TradFi folks, will also be doing more institutional transactions between each other. And that will also be happening on chain.
You're an engineer. Put some numbers on it.
I'm sorry?
Give me some quantified numbers here. So what do you like? What dollar amount you think is moving from Web3 back into TradFi, or how do you think about the volume of
what is RWA now at 170 billion, something like that in total when you add up all the stable coins?
Yeah.
I wouldn't be
But
surprised.
stable coins is the large majority.
Yeah.
Yeah, large majority. I wouldn't be surprised if we're at, I don't know, 400 or 500 billion. It's more than doubled.
Yeah.
In the RWA side.
Yeah.
And a lot of that flow, I wouldn't say 50%, but a decent percentage of it has come from the institutional world, in addition to the Web3 crypto world. Most of it has come from the Web3 crypto world, but some of the value has flown in from the institutional side. That's what I would think would be reasonable.
What do you think? What's when we're looking back a year from now, what's going to surprise people the most?
I don't think that the Web3 world will penetrate the TradFi world. I think it's the other way around. The TradFi people will try to create the TradFi products into the Web3. And I think crypto today, there's this 170 billion, but it's largely stable coins, 160 billion. I think you're going to see the yield-bearing dollar products, which are different varieties of tokenized treasuries, etc., to grow significantly faster than actual tokenized dollars. So today, if it's the tokenized treasury space is maybe 5% of the compared to the stablecoin market, I think it's going to grow to be like 20% of it, and it's going to grow significantly faster because it makes no sense to be using stablecoins for the things that we're using today. It's just a lack of quality products that give you allow to earn a yield that can replace a stablecoin.
Can I ask why you're not optimistic about the Web3 capital flowing into Web2? I mean,
I don't think it's going to happen in 1 year. You said next year.
Yeah.
So.
Well, so to probe on this for a second, right? Like, Tether has something like 80 or 90 billion dollars in treasuries now.
Who?
Tether, USDT, right?
Correct.
And so it is now something like the 18th largest treasury holder in the world.
But they have it on the web on a TradFi asset manager without putting them on chain or anything like that, right?
Yeah, but that's what I'm saying is like what happened was there was $100 billion sitting on chain that came in through on chain, and they moved it back into Web2 land and are now holding $100 billion in treasuries. Doesn't that sort of imply that like if there's another $1 trillion that comes on chain, that the path of least resistance is for that next $900 billion to find its way into commercial paper or AAA bonds?
Yeah, for me, I see it the other way around, right? That's actually taking TradFi products, which are treasuries, and create a crypto wrapper, which could be a tokenized treasury, or in the case of Tether, a dollar, and put them on the crypto space, right?
Sorry, that's what I meant.
Yeah.
So it feels to me that the Web3 into TradFi is more like the ETF space, right? Where you're taking a crypto asset and put a TradFi wrapper and put it there. And I think that actual tokenized assets being used in a TradFi environment, there's too much friction between the two systems.
So you guys are actually, I think, saying something very similar, using different terminology.
Yeah, I'm saying that there will be more traditional assets adopted by Web3 crypto people in these wrappers.
Yeah.
I'm also just saying that there will be, separate from the public chain Web3 crypto world, institutional transactions also.
Yeah.
And that'll happen.
Justin, what's your this is going to surprise people the most over the next 12 months prediction?
I'm going to give you a little bit of a roundabout answer, but I do think it's incredibly possible to create a Web3 native finance company that does compete with and challenge the incumbents in Web2, but you do have to build something in a way that is like Web3 native. So I think what you don't want to do is just sort of like lift and copy and drop what you do in Web2 onto Web3 and then expect that to be exactly right. Like you actually have to use the power of blockchain, and I say that somewhat sarcastically, unfortunately, but it's such a cliche, but like you actually have to use the tokens and the technology, right? So with our tokens, it's not just like the tokens represent T-bills, you actually can do interesting things with them. Like you can have a version of the token that looks like a stable coin where it pays out the yield of new tokens. You have a version that can be used as collateral, that you can convert between the two. You can bridge the tokens from chain to chain. So I actually think that, one, you can be a Web3 startup and compete with the incumbents, but you have to do that in a way that's innovative. But you really have to, and this is going to answer your actual question, work with the actual existing infrastructure, which is still, I think, really getting there and improving. There's all kinds of really awesome technology that is still a little bit in the proving grounds from a traditional financial perspective. But if you can build out institutional grade products that use this new amazing technology, things like bridging of tokens, things like DeFi protocols, and do that in a safe way where people with a traditional financial mindset, whether they're an incumbent financial institution or a Web3 native person, can use that product. I think that's the real unlock. That's the real use case where you actually have these products that people want to buy. You can actually use them within the DeFi protocols that have been battle hardened and people trust. And I think that a year from now, we're going to see tremendous improvements in things like bridging, things like even like token standards and consistency of token standards across this multi-chain universe that we have now. And all of that's going to really help developers build the actual platform in a way that ties in with Sergey's vision for this sort of internet of assets where the tokens all actually work together and you can sort of seamlessly move them across chains. And the user doesn't have to be, a rocket scientist equivalent of a blockchain engineer to make sure that your money goes from A to B.
So your assertion 12 months from now is it will all just kind of work and people will be surprised at how seamless it is 12 months from now in terms of it'll just all kind of work.
Yeah, just I think significantly better user experience, where they understand what's happening, there's more transparency, the chains are getting faster. I think there's a good bit of just using multiple different blockchains even for ARB. If you're trading some asset here and there and you can buy low here and sell high there, you need to be able to move the asset. And like a lot of that is just like really basic financial plumbing that really has dramatically gotten better even in the past 12 months. I think that's going to very much continue over the next 12 months.
That's great. All right, guys, we're at time. Thank you, everybody, for listening. Let's have a round of applause for the panelists here. Thanks, guys.